If the yield curve is flattening, that's the shape of an improving economy that's probably not headed to recession. So we're led by the Magnificent Seven off the lows, as people were very underparticipated. Now we're getting a broadening into industrials, materials, and other names and various market capitalizations. So the rally is now broadening. We are up against some technical resistance. I think people have sort of gotten the memo that we may not be headed towards recession. And now we're dealing with a little bit of a pullback. But longer term, I am bullish into the end of the year.
Todd Gordon, founder of Inside Edge Capital. And also, I know you run a research business called TradingAnalysis.com, and you've been a longtime CNBC contributor. Todd, it is so great to see you, and it's great to welcome you on the show. Thank you so much for joining me.
Oh, my pleasure, Julia. Thanks so much. I was excited when I got the invite. So thanks for having me. Looking forward to it.
I'm excited, and it was great to reconnect with you.
You
and
too.
Especially we got to talk about what's going on in markets these days, just kind of hearing more of your picture of things and also your approach and kind of the macro setup, if you will. What are the forces that are driving markets from your vantage point?
Yeah, it's it's a crazy world. It seems, I think we are definitely in sort of the new age of investing. There's a lot of norms, I think, that, we were taught when, we were first starting our career that seemed to be changing a little bit. And, we have the mutual friend that, introduced us a long, long time ago. We were trading in San Diego and I was 22, and I was always taught to kind of take a top-down approach, look at the four major asset classes, right? Equity, fixed income, commodity, currencies, and see how they're interacting. Sometimes the four asset classes are playing together and there's a lot of correlation in intermarket analysis. And sometimes it's, one or two playing. Right now, it just seems to be that for me, it's kind of like studying the 80s. I didn't really trade in the 80s, but it's like studying the 80s where a lot of different asset classes are driving markets here, a lot of rotation. So even if you're a stock trader, you have to know what's going on in the other asset classes. It's a fascinating market. It's a challenging market, but it's very fascinating.
Yeah. When you say new age of investing, can you elaborate a bit more on that?
Yeah. I launched a wealth management business 2 years ago. It was always my dream. We both left the city, right? I went way upstate New York in Saratoga Springs, New York, and about 3 hours north, and you went about 2.5 hour plane ride south, right? I think it's a new age. I launched it with the name New Age, and I think I got some pushback. People thought it was too hippity dippity, whatever. But I think we're in the second tech boom, right? I think the first one is the internet boom, and then I think this is the new age sort of technology that is, it's creating a lot of challenges to traditional fundamental models. You look at all the rotation that's specifically happening now. Semis are such a big part of not only the growth trade, but there's this huge move into more cyclical stocks, which I think we might get into later. But the semiconductors are driving the new age with AI, and I'm still a big believer that I do think we're going to be somehow interacting with the virtual environment or an augmented environment. And, I think it's causing companies to run more efficiently. The chips and the computing power they're buying can accomplish so much more. It's driving labor costs down. It's driving these really, really large multiples that, traditional Wall Street analysts have a hard time struggling with. And I don't want to be a rah perma bull, Julia. I'm a small boat. I could literally, in my wealth management and for my research business, I could close everything in an hour, go to cash, and even go short. So I'm not mandated to be long. So I'm not like a perma bull, but I am generally very bullish. I like what's happening here.
Yeah. Well, that's what I love about the show is you can have so many different viewpoints and different styles as well of investing or trading and whatnot. So I think it's helpful just to have a diversity of opinions and outlooks.
Well, do you mind if I just continue on that point?
Yeah, let's do it.
Like you and I both come from the media background where, not talking badly on it, but you have to have, we were taught, you and I in media school, to talk in soundbites and to have clear, soundbite worthy, clear takeaways. This is what's going to happen. Well, in reality, when you're trading and you're managing money, my own money and investor money, and and research clients are taking trades off of my ideas, you have to look at the market in a very binary and sort of a if then conditional environment. If A happens, we do B, and if C happens, we do D. And I really can't tell you what's going to happen now or in the future. You have to assess the now. So it's a very different thing from being a headline grabbing analyst and an analyst, which I part-time play on TV, but also a money manager. It's nuanced, but there's a very clear and important distinction.
Yeah.
I think that was the right word.
I think, no, distinction. Yeah, that's a good point too. And there is, as you point out, there is nuance. And I love getting away from the headlines because I just feel like, yeah, you can't really accomplish much with a soundbite or even just, everyone wants like a hot take or whatnot. On the notion of being bullish, you said you're not like a perma bull, but you are bullish right now. Can we talk a bit more about that and like the sentiment?
Sure.
Kind of, I want to hear more on the thesis there, or, what's kind of driving that for you?
Yeah, it's crazy right now. We just got hit this morning with the Moody's downgrade of the regional banks. And it's like, thanks. We could talk about, the actual numbers behind the regional banks and the market capitalization represents. We got the Fitch downgrade last week to catch up on, I believe it was Moody's who cut, no, S&P, who cut back in 2011. There's a lot of bearish sentiment going on right now. And, I think this market, back to the earlier point, is very much being driven by fixed income and not only short-term Fed policy where it's setting the rates, but, the more market controlled longer-term 10-year yields. And it's the interaction between the yields right now that I think are very much driving this market. We still have a lot of yield curve inversion on the notional 10-2 yield spread. Sort of the way the long-term rates, the 10-year yield is pushing up. 6 months ago, I was saying, oh man, I was watching a great correlation between those long-term yields going up, driving the rotation into value over the last 12 to 18 months. And all of a sudden now, I think we're starting to reach terminal Fed funds where the short term is sort of kind of capped out, but the long term now is moving up. And as I said, 6 months ago, I would have meant like, sell all your growth stocks. But what's happening is we're seeing a flattening of the curve, and not the curve that you think, like flattening of the yield curve. So it's kind of driving more economically sensitive sectors, which if the yield curve is flattening, that's the shape of an improving economy that's probably not headed to recession. So, what does that mean? I think, we're led by the Magnificent Seven off the lows, as people were very underparticipated. Now we're getting a broadening, into industrials and materials and other names and various market capitalizations. So the rally is now broadening. We are up against some technical resistance. I think people have sort of gotten the memo that we may not be headed towards recession. And now we're dealing with a little bit of a pullback, but longer term, I am bullish into the end of the year.
On the yield curve part, how much of that too, like, I just want to explore that more and like the interpretation of it. And you mentioned at the top of the conversation kind of, obviously, I was a baby in the late 80s, but we weren't around for like the market in the 80s. So like,
me too.
I imagine you're also like looking back to the 80s too, on like some of the yield curve moves then, right?
Yeah. So, I'm just looking at the chart here. I'm just, we've all read about the stagflationary 70s, and let's face it. I mean, that was 50 years ago. So even the most senior guys on Wall Street probably didn't live through it. So I think everybody right now is sort of reading the history books. I don't think a lot of us lived through it. Well, obviously we had massive inflation in the 70s. There was a lot of things going on geopolitically driving that. Commodities went crazy, interest rates went crazy, but what happened was right around 1980 was the top in commodities. Yeah, it was right in 1980, and it corresponded exactly with the high in the 10-year U.S. yield. And all through the 80s, what happened post 70s, we were in a disinflationary environment, which saw a drop in yields, a drop in commodities, and everything that we read about now, which was traditionally there's an inverse relationship between commodities and stocks because commodities are input prices and higher commodities will squeeze margins on earnings. So in the 80s, we had disinflationary post 70s drop which created a correlation between lower yields, lower commodities, higher stocks. So 80s was the top in yields and commodities, sold off. 82 was sort of, I would say, the birth of the bull market, with IBM going. And then we ran into 87 and we had a few other, hiccups along the way. But, to kind of skip ahead, everything changed and pull me back if I'm getting too far ahead, Julia. In 2000, the relationship that I just mentioned changed between commodities and rates because of the so-called BRICS. Like Jim O'Neill from Goldman Sachs came in and coined Brazil, Russia, India, China, commodity demanders and producers coming online, building up their economy. And that changed the relationship between commodities and stocks to now go together, where in the 80s they were trading inverse. As these emerging markets were coming online, they were demanding commodities, producing them, and that had created a positive correlation. Well, now we're seeing a Chinese slowdown. We know what's going on with Russia. India continues to do well, but on the whole BRICS relationship is broken apart. I think Jim O'Neill was knighted for he's Sir Jim O'Neill for that. But I think it's over, and I can't help but think maybe we're going into a smaller sort of disinflationary 80s where commodities are down, boosting margins. Because Julie, you know this, like the recession, the stock market recession that they told us we were going through, it wasn't an earnings recession. It wasn't a revenue recession. It was a margins recession. It was a EPS recession, and more so guidance. It's not so much what companies are reporting now. It's what the guidance was going to be for the end of the year and the next quarter. And they kept saying margins going to be squeezed because of supply chain with COVID and all that. But, maybe we are going through a lower commodity cycle here, and that will go back to boosting margins. And maybe that's one of the reasons, we're seeing these industrials and materials move up. And guidance is still not great here in Q2 earnings, but yet these industries and sectors that I'm talking about, more so the sectors, continue to power ahead. Yield curve is flattening. I don't want to try to be too smart and overthink it, but I'm just trying to pull some of the lessons that we read about in the 80s forward to today in 2023.
Yeah. Well, again, it's fascinating just to hear different ideas. On the 80s front, you mentioned the disinflation.
Yep.
Can we explore that a bit further and what the implications could mean for the market?
Yeah. So stocks generally do well in disinflationary environments. And, we have CPI coming up. So we have CPI coming up Thursday. I think they're looking for 3.3 on the headline, and core is continuing to be sticky, but generally disinflation is good. So, increasing prices, but at a slower rate, lesser rate of change is generally good for equities. And again, just the margins and the guidance. And if we can start, stop having all the CEOs prepare for recession and kind of lock down on spending and all that, I think that would generally be a good thing. Going back to the last point, if you're watching industrials, I bury myself after we get off this. We do a sector industry stock report for our clients on Tuesdays, and I'm going to be spending all my time in industrials and materials. You look at some of the sub industry groups and industries within materials, like building products and electronic components, even in the home builders and everything related to home building. These stocks are ripping. They're in a massive bull market, and everyone's so focused on large cap growth in tech, which I get it. But there's a big boom happening right now in those very economically sensitive cyclical sectors, not so much those magnificent growth sevens with huge valuations. So, I think part of it too, we have, $200 billion in infrastructure spending that's ready to go into the economy. And I don't think the CHIPS money has been deployed yet. I think I just saw a headline, and one of my guys just messaged me right before we got on. I don't think that money has really been deployed yet. So maybe the market is pricing that infrastructure build in, and we need to be looking again at those more cyclical, non-tech industries.
So you like materials and you like the industrials? I
do. Yeah.
Gotcha.
We have a pretty good allocation right now in a research business and in the wealth management.
Mm-hmm. What else, when you look at the equity market, because you mentioned the Magnificent Seven, and also at the top of the conversation, kind of this like new tech boom. Do you feel like there's still more room to run in the Magnificent Seven, or what are you thinking about as it relates to that kind of tech boom setup?
Yeah, I mean, I don't know. I do think we're going into the new age. I don't know. My kids are 9, 9, and 4. And I swear to God, we've been long probably 15 iPads. Like they break them. They don't lose them, but they break them and they wear out. And, in terms of Apple, I'm just thinking about the pullback in Apple we've seen over the last couple of days. It was like 188, 189. It was trading 177. Nice little pullback here. I think I love where Apple is going. I don't even care about this earnings report for Q2. I sold calls for my position just above Apple. I wasn't really worried about it. I wasn't expecting much. I think that iPhone 15 upgrade cycle is real. I mean, do you have an iPhone, Julia, or what do you want?
I think I have the 13. I don't know. Maybe it was either the 12 or the 13. I don't remember now.
I had to look. I didn't know either.
Honestly, don't know.
Yeah, no, I didn't know either. I looked 2 days ago. I was like, oh, I have the 13. I think a lot of people skip the 14, and I think the 15, which comes out in September, is going to be real. I think that it's going to be a pretty significant. I think Dan Ives, who I really like, I think he quoted it as a mini upgrade cycle. And then, the Vision Pro, I was going back to the iPads. Like, I don't know. I think I have the record on CBC. I was like the first guy to put the Oculus VR goggles. And I did a Facebook options trade in virtual reality, and it's on CNBC.
Very cool.
I think it's awesome. I think, we just got to get over the form factor for it. But, is Meta the hardware company to do this and kind of move us into the next phase with this? I don't know. Now that Apple's involved, I think this is a really good thing. And, they came out with a super high sticker shock price for the Pros, and there'll be lower value ones that, again, these are going to be what we're buying our kids instead of the iPads. I would bet, and I am betting on it, but I'd do a friendly bet with anybody that this will overtake iPads. And I would say,
you think the virtual reality
100%.
headsets?
Yep.
Interesting.
Yep. Yeah. I know I'm in the minority here. I've seen it. I've investigated it. And what's the bid in these semis? Where is this coming from? Are you telling me all of a sudden it's just because of AI? AI will feed the virtual and augmented reality. This bid and this premium in chips and this relentless move up in chips is pricing in something. And okay, we got hit with AI in the last 6 months, which is great, but we are headed towards that. Bandwidth is more available. Elon is putting 40,000 satellites in lower Earth orbit, LEO, to blanket the globe in, moderately high speed internet. Bandwidth is getting better. We are going to consume bandwidth in real time and interact in real time. I have no doubt about it.
Yeah. It's fascinating. Also, like just paying attention to the young people, like the kids, and what they're interested in. I think,
they're all gamers. Yeah. Like they're all living, like my kids don't watch movies. I have to beg them, force them to sit down and watch movies. They want to interact on YouTube. And the minute you can stick their head in virtual reality and they can consume the content and the gaming that they want, yeah, I mean, we don't, Julia, I don't think we're going to have to sit behind like 7 feet of monitors soon. Literally, we'll just be able to put on glasses and set up our trade space.
We could do or even a virtual reality podcast and invite the audience to put their headsets on and watch it live.
100%. Yeah. I mean, you and I could just do this anywhere. Like if you could do this podcast anywhere, where would it be? Where would you go right now?
Oh, I don't know. I don't know. I don't have an answer.
It's not that far away, is my point. It just bandwidth is getting so much wider, so much more readily available. And again, that incessant bid and premium that the chips are trading. Like, one thing I put out yesterday, I threw up a chart of Apple, which was selling off, the SMH, semi holders, and XLI, the industrial ETF. The semis are trading with a tighter correlation to industrials than they are right now with like flagship growth, which is Apple, right? Again, I think it's going back to this massive infrastructure spend that's going into technology, semis, electronical equipment and components and stuff like that. Like semis are trading more like industrials right now, which are on this incessant move up. And I think it's just going out to this build out that I'm talking about.
Yeah. Let me ask you another follow-on question, because obviously you look at the market so closely. Um, a lot of folks have just pointed out that, the market's been driven by the Magnificent Seven, that it's been pretty narrow, but you don't see it that way. You see other parts of the market that are driving it.
100%. Like I did a study, I don't know, 2-3 weeks ago. And I think of the NASDAQ 100, the NDX, I think 25 stocks were outperforming the NDX year to date. So 1/4 of NDX stocks were outperforming the NDX or QQQ. In the S&P, it was like 210. And I'd have to go back and update those numbers. Those are going to be about 3 weeks old. So 200 out of 500 S&P stocks are outperforming the S&P for the year. We have Meta, you have Google, Google's been lagging. You have Nvidia, which is just crushing, which I can't wait, until the August 23rd earnings. I mean, you remember what happened last quarter, Q1 Nvidia the street was off by 50%. So there's a few that are leading, but if you look at below the surface, there's been a significant rotation, not only in large cap, but we watch this sector rotation model called relative rotation graphs. It actually takes sector rotation, which everyone talks about, and allows you to really quantify and see it at work, which is awesome. You're seeing a rotation not only in large cap growth, which is actually rotating out right now, but small cap and mid cap growth is rotating in, but also small, mid, and even to a lesser extent, large cap value is starting to rotate into favor relative to the S&P 500 benchmark. So the participation is by far broadening. And everyone was throwing the headlines out there 2 months ago. Oh, we're only being led by 6 or 7 stocks. And it was already changing below the surface. And I couldn't help but sort of chuckle at it. So with this sort of development in the interaction between these long end and short end interest rates, which is the yield curve, we're seeing a flattening of it, and we're seeing a rotation in more economically sensitive, cyclical stocks. So clearly, it's already happening. The rally is broadening for sure. And right now, again, we're seeing some large cap tech sell off a little bit. Q2 earnings have been solid; they beat expectations, but again, I think guidance has been a little uncertain. So we're seeing a little bit of profit taking in tech, which is fine. I mean, from a technical point of view, I like the pullback here in the NASDAQ. I like the pullback in Apple. Nvidia is just hanging up here at the highs, waiting to make the next move. Even communications like Netflix and Google, and even some of the streamers and some of the studios have starting to get a bid the last couple of days. So I think we're just in a little bit of a short-term pullback. Exactly how deep we go, I'm not sure yet. But as I keep kind of harping on, the cyclical stocks like industrial materials are working, but I'm also very much ready to buy the pullback here in growth.
Mm-hmm. And, you were just alluding to the relationship of U.S. yields and the value growth rotation. Can you help me just better understand that relationship?
Yeah. So this has been, my customers and clients and wealth managers are sick of hearing about it by now, but when the inflationary spike came on in the end of 21 through 22, what I did is you take the value ETF, you could do iShares, you could do Vanguard. So I think, VTV divided into VUG for Vanguard value growth. And if you just overlay the US 10-year yield on top of it, they were lockstep. I mean, they were literally right in line through the end of 21 and 22. So that means is, as the inflation massive spike was unfolding, rates were going up because, of course, you don't want to hold bonds in an inflationary environment. So bonds are selling off, yields are going up, and investors are rotating out of growth into value. So that created this really good correlation between value growth ratio and the 10-year yield, right? So then all of a sudden, the calendar turns this year, the 10-year yield stays bid up around 4%, but is not breaking. It goes like 3.8, back up to 4, 3.9, back up to 4, 3.7. It's hanging out. And that's allowing the growth trade to now rotate back in. The growth trade has been outperforming value for the first 8 months of this year. Now, all of a sudden, last week with the downgrade, we got the 10-year yield going above 4. And 7 months ago, I would have said, growth is in big, big trouble. And we are seeing it sell off a little bit. But now what's happening is I think the focus in this market is going not towards the long end, but now the short end. Is the Fed really done? And again, just that whole yield curve. The other chart that I sent, and again, I like to look at this sector rotation, is the, this big old RRG done by my friend Julius de Kempenaar, who gave us this actual 4-quadrant rotation, looking at, whatever sectors you want to look at. So I'm looking at the mega cap, small cap, mid cap growth rotating in here on the left side, and value, mid cap, small cap, large cap value rotating out. And basically what you do is you break it into 4 quadrants, right? So the top left is improving, top right is leading, bottom is weakening and improving. So you're constantly rotating in a clockwise fashion around some center benchmark. The point of this whole thing is this is a monthly rotation that I'm looking at. Mega cap growth on the monthly started rotating in about 2.5 years ago. It has not yet moved into the leading quadrant. It is not yet even leading. And if you go back and look at the history of like how long it'll stay on the right side of that chart in the Eastern Hemisphere, it'll stay there on average of about 2 to 3 years. So the whole point of this is if you look at the real rotation of growth on a month over month basis, going back the last 20 years, when it does move into the leading, it tends to stay there for 2 to 3 years. So again, this is why I'm very bullish. If we're going to make the move into leading on the RRG, we could be here for the next 2 years. So when you say, can chips and growth and large cap tech and Microsoft and Google and Amazon go more? Absolutely. Because there's historical precedents to show, yeah, we could. And plus, I think a lot of people are still bearish, underparticipated. I think shorts have come off. They're not believing it. I think they're afraid of a 5% Fed funds rate. And I would say the market's handling it quite well. I'm impressed how well the economy's handling this huge move up in short-term rates.
To that point though, with the rate in with the rising rate environment, isn't it kind of unusual though for stocks to go up in a rising rate environment? And why do you think that is?
Well, again, I think we've got to look at it again, the relationship between the short end and the long end. And, we have yield curve inversion right now. And so many, again, headline grabbing, analysts are saying, look, the last 2 times we had yield curve inversion was 2000, 2007. It brought on recession and it brought on a significant stock market sell signal. And you say, well, third time it must happen again. Again, I guess I'm kind of stuck in the 80s. I mean, music was a lot cooler back then. I don't know. Do you still listen to the 80s? I think no.
Probably, but
are you top 40 like my wife?
No. Okay. My husband was born in 1979, so I'm getting more into his stuff. That's where we differ is on music and movies and yeah.
So okay. So you just dodged the 80s. You're not okay. 80s movies, 80s music, whatever.
I like 80s movies. Yeah.
Oh, they're awesome. So if you look at, the last couple of times, there was 3 times in the 80s that we had yield curve inversion. And I brought that chart along too. There was right in 80. Again, we had it in 82. And then I think we had it right at the end of the 80s into 90 when the first Gulf War started. Well, we had yield curve inversion that brought on recession, but that was an unbelievable stock market buying opportunity. So it's when you start moving into inversion, but then you start flattening. There's 3 times in the last 50 years where it was a stock market buy signal. The prior to, a little bit of recency bias, again, is showing that, people are trying to sell the market based on that. But there's times, historical precedents. And again, the point that I was making is we have a disinflationary environment like the 80s, not like 2000s when BRICS was very much in favor, creating a direct correlation between stocks and commodities. So, when you have yield curve flattening and the way it's flattening right now is shorter term rates are starting to move lower as longer term rates are starting to move higher. flattening that yield curve, you have precedent to say that's a stock market buying opportunity. And, I see it's a good thing. I mean, I think people are a little pissed off at the bond market, rightfully so. A lot of people, worst time for a 60-40 portfolio and a long period of time. And, I think they're a little burned. I think they realize that there is return to be had in the equity market and people are living longer. I think people are working longer and they want the return. So, okay, so maybe we're selling some more long end bonds and, we're going to continue to flatten out that yield curve and people are moving more into the stock market. And again, going back to where Fed is in the short term, I think it gives people confidence to go into investments knowing the Fed has some elevation now, which if another shoe were to drop, they can cut. We have 525 basis points now of elevation coming off of ZERP for a long period of time where I think the market's handled it really, really well. I'm really impressed with it. And again, I'm not trying to be a permeable rah cheerleader.
Yeah. Well, also, let me ask you this then. What do you think the bears have gotten wrong? What do you think they've missed or misanalyzed?
What a great question. And I watched some of the, most respected macro hedge fund managers, sell side Wall Street analysts just be dead wrong at the end of 22 and that March pullback. I get it. I get the bear case where, we had QE 1, 2, 3, QE infinity, artificially suppressed interest rates, global, our debt is astronomical. I get it. I get the bear case, but the markets adapt. You look at inflation that I think Powell has proven to be right. He took a lot of flack for saying that inflation is transitory. Well, if you look at the rate of change in CPI on the way up versus the way down, on the headline at least, it's come down faster than it went up. So it has been transitory. So I think people are too quick to say inflation is going to be here longer than we'd expect. Core has not come down. So we still have shelter. That's a problem. Some insurance, used car market is crazy right now. So, I think that's the one thing that they got wrong. But, for me, we don't have a manipulated economy by monetary policy, suppressing interest rates, post GFC. It feels like it's a more functioning economy where we can have more price discovery. We have VIX, Julia, we had 10 or 11 was our regime of VIX for a long time. Now it's up around 13, 14, 15 is the new floor. So we're having price discovery. It's a more functioning economy. And again, if something happens, the Fed can cut rates. So what did they get wrong? Again, also on conference calls, on quarterly calls, almost every CEO was guiding lower, setting the bar extremely low for coming quarters. Everyone was doing it. So why not? Why not very much under promise and then over deliver on the next time, and let's just do it over. It just seems like it doesn't even matter what current EPS is. It's all about what the guidance is and analyst revisions going forward. So I think that was part of it too, where CEOs are just saying prepare for the worst and hope for the best. And it seems to be that, that's what people were listening. So I don't think I clearly answered your question, but I don't know. I don't know what they got wrong. I don't know. Maybe we are in maybe it is different this time.
Yeah, maybe. I want to bring up another topic with you just because I actually really enjoy having folks who do technical analysis on the show because I feel like I think a lot of people, it makes it more approachable when you have time to talk about these things and explain these things. And, I've always heard folks mention and talk about the Elliott Wave. And I know this is something you do in your work as well. Can you explain the Elliott Wave for that more novice person out there
Sure.
myself? And what does that signal to you? Especially for, I think you have an outlook for the Dow because of it as well.
Yeah. So that, or Elliott is a curse and a blessing for me all at the same time. I was just kind of born with it. I started prop trading when I was 21, right out of school, and I got exposed to it really early. And it just made sense to me. And I'll give you the quick background, but it's nothing more than a catalog of patterns. There's a few rules. There's quite a few guidelines and, expectations and things you look for. It's basically just disciplined pattern recognition. So technicals, you're studying momentum, you're studying trends, but then you're also looking at patterns to figure out, how progressed a trend or correction may be. Because everything we're trying to do, Julia, everything we're trying to do as investors or traders it all boils down to this. You're trying to buy short-term weakness in a longer-term uptrend, or you're trying to sell short-term strength in a longer-term downtrend. So you're trying to identify the trend of the market. You're trying to identify the end of the smaller degree corrections and when the trend might resume. And then you're also trying to figure out when the longer-term trend might be tired. And Elliott, he took Charles Dow theory, part of the Dow theory, which Charles Dow, Dow Jones Corporation, he gave us this brilliant concept that markets advance generally in three phases. So in the beginning, after a long decline, is accumulation. Then you get the first setback, and then you have a widespread participation as, people originally were, thought the first move off the low was short covering and sentiment is very bearish. Market pulls back, heads back close to the lows, and everyone's like, yep, told you we're going to new lows. Then all of a sudden, we get fundamentals that have already bottomed, technical momentum, which has already bottomed, and the sellers dry up. All of a sudden, shorts start to cover, bottom picking longs come in, and then you get a breakout above that first reactionary high. And everyone's like, oh my God, what just happened? And then the market rips on the top side. Momentum guys get involved, the underlying economy improves, and that winds up being a third wave. And then we have sort of a hangout consolidation. Everyone catches their breath in a fourth wave. And that's kind of where I think we are right now in the daily S&P and the NASDAQ. And then we'll have another fifth wave move. Well, that's called distribution. So Dow gave us accumulation, widespread participation, and then distribution. And after a correction, that phase or that whole three trend will start again. Elliott Ralph Nelson Elliott, who worked for the Coolidge administration, I believe that's right. He was actually he was sent to South America to work out the finances of some South American countries based on his accounting background. Well, he got sick in his later years, didn't want to do government anymore. So he sat out on his porch and he just started drawing out hourly and daily charts of the Dow by hand. And he took Charles Dow three swing theory and just went much deeper with it. So it's really based on Charles Dow. So it's catalog of patterns to figure out where you are, when the trend might be continuing, when corrections might be continuing or over, and just give you context of where you are in your trade or investment. And then using those rules and guidelines, that's how we come up with our points of confirmation, our risk management levels, and our target.
And hence the Dow to double in the next 5 years.
Well, yeah. So, anybody who's studied a little bit of Elliott Wave, this is a pretty unpopular theory, and it gets a little deep on this one. But yeah, I do think that, a good 5-wave move happened from the GFC lows, 2008. We had two good corrections there in 12 and 16. And then we had 18, where the Fed was raising rates. We had the Chinese tariffs. We had moved down in A, up in B, pre-pandemic. And then C was the 2020 pandemic low. So that created what I think to be higher degree correction, the largest degree correction post global financial crisis. So if that's the second wave, that would mean the prior wave from the global financial crisis lows was the accumulation. Now, if we are in fact moving higher in the next trend wave, this is going to be widespread participation. So a lot of people are trying to call the top, and Elliott gets a really bad name because a lot of people are constantly looking for the 5-wave move, Julia, and they're like, oh, sell it, short it. And you're like, dude, no, it's always part of a bigger pattern, because generally, and this gets a little foo-foo and kind of esoteric, but Elliott really is designed to track human interactivity and our progress and output. The more and better humans are getting along, the more our productivity, the more ingenuity we're seeing, the better our output on our GDP is, which that is measured in the stock market. So it measures human productivity and output. It measures human interaction. It shows sort of the psychology that drives markets. And it's the psychology anticipating and reacting to the data and the fundamentals and macro that's, being, put out there in the market. Markets are always forward looking. So it's really studying mass psychology, but it's also measuring how we're doing collectively in the stock markets, our scorecard. So I'm generally bullish on humans. I think I'm generally an optimist, and I think, it's unfortunate that I think too many in our social media and in our traditional media world are headline grabbing, and I think trying to be a little sensationalistic. And it's much easier to throw a bearish headline out there and scare people and grab clicks. Where, when you're running money, my own money, clients' money, my parents' money, my kids' money, you've got to separate that out, and you've got to acknowledge it and know what people are consuming. But you've got to be able to have the courage to set that aside and say, are they just trying to be a little self-serving? And I'm not trying to be petty, but that's what creates people who sold out of their positions or go short and they're going to need to buy later, which propels this market higher.
Yeah. Can I ask you just this is a random question, just
Sure,
thinking about
please.
this. Have you ever found yourself bearish where you made a mistake from being too bearish or being pessimistic?
Absolutely. Yeah. I had I think I took it off in March or April. Yeah. I think it was April of 2023. I had 15% cash in the wealth management. I was concerned we were moving lower. I had a 5% allocation in PSQ, which is a short NASDAQ ETF. So we had 50% cash. I had 5% of an inverse ETF. So, 20% not invested in the market in April. And then I started to realize, wait a minute, this is wrong. There started to be some things that were changing. And I quickly went out to clients. I was like, look, we missed a little bit of the upside. I said, I don't think the world's going to fall apart, but I think I'm wrong by having this 15% cash and 5% allocation was short. So I closed it and I recognized it. And look, your job is to be wrong as a trader. You're going to be wrong. Your job is to get out of that wrong position as quickly as you can and right the ship. So it was just 5 months ago.
Yeah. Well, I appreciate you sharing that. Todd, I have to say, I've really enjoyed having you on because I feel like I've learned a lot from you. I took a ton of notes, and I think they're helping all of us. I do want to give you a few moments as we wrap up here to share some parting thoughts with folks. Anything that didn't come up in this conversation that we should have brought up? And then also, can you explain more about the work you do, where folks can go and learn more about whether it's, your research, for example, and also where they can follow you? I know you have a YouTube channel. I know you have Twitter, but just take the last few minutes to share.
Sure. I appreciate that. I've just been heads down over the last 2 years. I've been doing much on social, haven't been doing much on CNBC. I'm trying to build, rebrand Trading Analysis, which is now in our 11th year of operation. And I'm trying to make it sort of a portfolio management research company. So what we're doing is we're building portfolios. We have an actively managed stock portfolio, which we set up our week. My team is cursing me for sure. They've had a hellacious 2023. We worked all through the summer. So what we do is Mondays, we do Macro Monday. So we figure out big picture stuff that's going on, that's driving the market. Right now, it's obviously earnings and a lot of interest rate stuff. And then Tuesday, which is today, we do the sector industry stock report, SIS. We call it Taco Tuesday. And then we go into, based on the macro themes that we identify, then we go into sector rotation using relative rotation. And we find the groups that are really moving. And then we'll go into tomorrow, which is Elliott Wave Wednesday. We'll take 15 or 20 of those stocks and go through them on a fundamental technical basis. And then Tactical Thursday, we'll talk about inclusion in our portfolios or not. So I'm breaking the research business into that. I'm at the same time launching a RIA wealth management business, basically using that same style of approach. We have 2 longer term portfolios, but we have an actively traded portfolio. We do option hedging. So I'm trying to bring active management to the forefront because, one of the things, Julia, I think a lot of our viewers, I would say, are men and women in their 50s and 60s. And the one thing that I've noticed, Julia, that you and I haven't gone through is when a man or woman has been making money their entire life, working hard at their job, doesn't matter how successful they are. Once they get to that retirement age and the thought of no longer making an income goes into their life, there's a huge psychological shift. And I didn't know that until I went out into the money management world, and all the, the customers who have been following me at Trade Analysis for 10 years are now say, Todd, we feel like we know you, feel like you're part of your family. They know, how much I'm on top of this market and how much I take it seriously, but also how important active management is. Because even though I missed out on probably 5% return on the upside in early 2023, I was very much on guard. I was not going to sit through a significant drawdown. And the person who, again, has a really successful career and worked hard for that money, once that income is done and they go into retirement, they want someone who is watching this and is not going to sit through another 50%, 60% decline. Because you asked me, when was the last time you're wrong? And what did the Wall Street bears get wrong? Nothing. They didn't. I don't think they got anything wrong. I mean, if you look at the textbooks, the market should have gotten crushed, and it didn't. So, I think that's the biggest thing that, I'm trying to build two businesses that, the work that I'm doing, is sort of, I can leverage it in both ways. And if people don't want to become wealth management customers, they can certainly come into the research and see the process. But I think active management in this increasingly complex world is really important. And I think, again, those who are moving into their 60s don't want to sit through a significant drawdown. So this always in, ride it out thing, I don't agree with.
Can I ask one follow-on question
please.
To that? When you talk about active management, because on this show, we've talked a lot about like passive investing and like index funds.
Yep.
Is that something that you ever ponder or think about too? Like, does that pose a risk?
It doesn't pose a risk. If you're 35, dude, buy as much of the NASDAQ QQQ as you can, or XLK, and just don't do anything. Right? But if you're 60, yeah, you can have a piece that is passively invested, and you should. But what's the psychology you're going to go through if the market does roll over from here and we go down 50%? People get so emotional, especially when that income stream is no longer, because people aren't getting pensions anymore. You tend to make emotionally driven bad mistakes. You're falling victim to headline fear mongering, unfortunately. So there's no problem with it if you know that money that's passively indexed that you're not going to touch, as long as it's part of your financial plan and you don't mess with it, and it's money you don't need for a period of time that you agree with your wealth manager. Fine, there's no problem with it. But if you're prone to doing something emotional, man, I've had people come to me. It's sad, like these people who just got tried to overthink things and just made bad decisions, have missed out on hundreds of % of return, and it's changed their life. So I think you have to have it as part of a plan. There should be some always in money that you're not going to mess with, but then you have to ask, if there is a drawdown, how are you going to feel? How is that going to impact your life? And this is something, Julia, like when we've known each other probably 15 years now. Like when I first started trading, I was always taught in the smallest time frame, only trade with money you're comfortable to be at risk. Mm-hmm. I traded for a hedge fund during 2008, 9, and 10 during the GFC, and they would let us trade pretty big size. And it was trading OPM, and my boss had a bunch of money in the fund, and I got a little nervous, and I was a little quick to get out of trades because of the dollar size. But once I cut my size and I knew what the plan was and how much money I had at risk, that's when I started letting the trades play out, letting my trade plan go to completion, and my profitability skyrocketed. So, as I'm getting older, I'm starting very short term, I'm going longer and longer. That money that you just asked about, as long as it's part of the plan and you're okay with a 40% drawdown, if the stock market gets clocked and you're not going to make an emotional decision, fine. But if you're prone to it and it's going to change the way you live in retirement and your quality of life with your family when you're in your 60s, that needs to be actively managed. And somebody, and this isn't a sales pitch, it's just whoever you go with. I think there's a shift that happens when people exit their earning years, and you want to have it baked into the plan. Hopefully that makes sense.
It does. Well, I have to say, Todd Gordon, founder of Inside Edge Capital. Great to have you on the show. Great to see you. And thank you so much for being so generous with your time and your ideas. I really appreciate you coming on. Thanks again, Todd.
It was so much fun, Julie. Thanks so much. And congrats on the podcast. You're getting some top quality guests. Thanks for slotting me in there.
Thank you. I appreciate that.